We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Angela Yeo, who's a Senior Director Analytics for AM Best. Angela, welcome.
Thanks, Richard. Good morning.
So Angela, you're based in our Amsterdam office. You've got a good oversight of some of the developments in the European reinsurance industry. Can you tell us a bit about how some of the developments that you've seen over the past years have been playing out in 2022 and perhaps how they might shape out in 2023?
Yes, thanks, Richard. Well, maybe let me start with a little recap of the 2021 results and focus there on the big four European reinsurance companies, which are Munich Re, Swiss Re, Hannover Re, and SCOR. So basically, for first time in many years now, three of the four big reinsurers have actually closed with a combined ratio below 100%. That's very positive news. All the reinsurance companies reported a growth in their premiums. Which is largely driven by rate increases, which is, what we have seen, sort of a trend that we've seen in the past years already. It materialized again, and it is expected to continue to improve still. On the net technical, on the non-life technical results, we've seen improvements and stabilizations, largely also due to the absence of further developments of COVID losses. We've also on the flip side of that, we've seen, unfortunately, some more loss developments in regards to excess mortality losses on the life side. So all these, big reinsurance companies have exposures to US life books, large US life books. But there's different degrees of that. So it's, but unfortunately that is also still unclear how that will continue. And whether or not COVID is going to come back this autumn, that might have an influence on the excess mortality rates again. Returns on equities have been very positively as well for all the companies. We've looked at the half-year results 2022 as well, and it's largely still a positive picture. So again, 3 out of the 4 have come in at combined ratios just below 100%. So it's it's uncertain times. Of course, we'll have to see what will happen at year end. Shareholders' equities levels are down. They have been down somewhat already in the end of 2021. That was largely driven by exchange rates variations. 3 of those big reinsurers report in euros, and when we do our analysis, we do convert that into US dollars. Another thing that we're seeing now is all the companies that we are looking at, largely looking at, are reporting unrealized losses this time around. So we do expect potential further drops in shareholders' equities towards the end of the year.
So there's a balance of headwinds and tailwinds there that's quite clear, but there's a positive message underneath some of that in terms of improving earnings. How sustainable is that?
It's a good question. We do think that certainly going into the next renewal rounds, we would expect some more rate hardenings, especially in some of the property cat lines, for example. And it's also an interesting point. We hear in the markets a number of reinsurers globally are either reducing their capacities or even completely withdrawing from property cat. That's not the case with the big four reinsurers. They have really reinforced their commitment to writing property netcat.
And that's property netcat in Europe or globally? Interesting. And what do you think is driving that appetite where other people are perhaps pulling back?
It's I think it's a combination of experience. It's a combination of relationships, and of course the big four are truly the big four. They are in our top 5 rankings, so they do also have the power of setting the rates. They've changed their business mix somewhat. They've decided to maybe withdraw or exit to some degree from the the working layers. They withdrawing from aggregate covers, increase some of the limits that the top layers there. So there's a lot of experience that comes into play that sort of makes those supports those changes, and then together with still being able to set the rates at the appropriate rate.
So experience is a really important point. There will be some people who perhaps haven't experienced a genuine hard market before. What surprises might we see?
Oh, it's a really difficult question to answer. I think generally speaking, what we hear, companies are very cautious in their approaches. It's not the time to be opportunistic and to just make money where there's an opportunity, because the opportunity would be out there for sure. The demand is there. But, generally speaking, companies are very cautious in their approach. What sets the bigger global reinsurers apart is of course also their ability to understand the risk, to that they have their in-house models. They're not just relying on proprietary models as well. And it's something that we've also discussed recently a lot. That the reliance on modeling tools and the potential pitfalls that come with that.
So one of the other constituencies that we talk about is the investor community. Is the insurance industry as attractive to investors as it has been?
So again, over the past 8 years or something, right, we've seen a real change in 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 the alternative capital that is available to the reinsurance market. And what we've seen is that sort of over the years, a trend has developed into something more of a partnership. Partnerships, they will still continue. Investors are to a degree still very interested because it offers them, sufficient diversity. What we are also seeing is that investors are equally cautious as reinsurers themselves are. So, in terms of expectations on returns, in terms of wordings and contract features, it's all much more detailed, much more structured. Investors have been a bit burned in the recent events from 17 and 18. So, you hear a lot about trapped collaterals and things like that. So investors have to be naturally a little bit more careful before they make that decision as well. I think capacity is still out there.
Angela, thank you very much indeed.
Thank you, Richard.
For AM Best TV, I'm Richard Banks.